All right, everyone. Well, welcome in. We're here in May, which is crazy that we're already in that part of the year. But they all seem to go fast anymore. So, welcome in. I'm Jarrod Musick. I'm the CEO here at Destiny Capital, and on the investment committee along with Tim Doyle. So I'll go ahead and let Tim introduce himself.
Yeah, thanks, Jarrod. As Jarrod mentioned, I am Tim Doyle. I'm the Chief Investment Officer here at Destiny Capital. I lead our investment committee, where I partner with Jarrod, where we do a number of things on the investment committee. We oversee capital market research, investment manager selection, fund due diligence, portfolio construction, and more. And we coordinate with our client service teams in executing the investment policy statements for our clients, and overseeing that as well. And of course, we have our monthly webinar here, where we have a lot of really interesting stuff to talk about. There's never a shortfall of stuff to talk about, and this month is no different. So we've got a lot of interesting stuff to dive into today, and I'm looking forward to it.
Yeah. And just a little primer, if this is your first time joining us for one of these, I'm going to walk through our personal wealth operating system for about 30 seconds. If you've joined us many times, please humor me. It's only going to take 30 seconds. So we really look at everything that we do for our client families through this lens where we have different pillars. And so the first one is get clear, make sure we understand what's happening in our clients' lives, what they're trying to do, and how do we pull that into the investment decision-making process. Grow Wealth is where we spend a lot of our time in these webinars. We're talking specifically about markets, opportunities, risks, taxes, changes in policy, everything that impacts sort of the macro or larger investment marketplace. That's what we talk about here. Minimizing risk is a portion of investment management for sure, and we'll touch on a few of those risks today, as we always do in these. For our client families, that's also estate planning, insurance, looking at business operating agreements, things like that. Uh, and then the last two, one is for business owners optimizing the equity that you have inside your business. And all of this is really intended to maximize life. So, helping create the conditions and the financial resources that our client families want to be able to live the lives that they want. So, we're going to focus on Grow Wealth. And with that being said, I think we'll head to the start of our discussion today. So, a big change in terms of a person, right? So, not necessarily a big change in interest rates or in policy, but we have a new Fed chairman for the first time in a long time. And before Tim and I hopped on, we were talking about, wow, we're getting older because we remember when it was Alan Greenspan, and then it was Janet Yellen for a while, and it's been Jerome Powell for quite a while, and now we have Kevin Warsh. So this new person that we're going to hear a lot from in the years to come. Who is he, and kind of what are we thinking that means for the FOMC and Fed policy?
Yeah. Yeah, it should be really interesting. In my markets and economy blog this month, I wrote about, changes in management, and I use sports as an example. When a team in the midst of a struggling season, they may switch managers. I just saw that happen with my Philadelphia Phillies. They fired Rob Thompson and hired Don Mattingly as the interim manager. And as a fan or as a consumer or as an investor, you're kind of thinking with the Fed, like, what does this mean, right? Is this going to indicate some kind of change, good change, bad change? And we're going to touch on kind of what we're seeing, what the current environment is, who Warsh is, historically speaking, how he's voted as an FOMC member, and the way he leans when it comes to interest rate policy and how that's changed over time. And then just talking about, the bottom line, what we really think is going to happen with the Fed, if anything. So, just some basics. Warsh was nominated as the Federal Reserve Chair on May 13th. As Jarrod said, he's succeeding Jerome Powell. Powell will remain part of the FOMC moving forward until, I believe, 2028. So he is not going away, but obviously Warsh is going to be the one at the press conferences after each FOMC meeting, and somebody who's going to be, driving the commentary and the perspective of the Fed there. And it's kind of, I view this as a bit of an unenviable job, and that was the case for Powell as well, right? It's been a very, very tough environment for the Fed over the last, let's call it 5 years, moving out of the COVID pandemic and then an inflationary environment, seeing inflation come down. Now we're in a position where we're still seeing issues with inflation, and we have that recently largely due to the conflict with Iran, the war in Iran and the closure of the Strait of Hormuz. We typically start with that each month and talking about an update on the war in Iran and the closure of the Strait of Hormuz. And there's really not much that's changed there. So we're not going to spend a lot of time talking about that conflict. But it is impacting higher prices, and we are seeing that with inflation moving higher. Headline inflation, as of the last reading about a week or so ago, was at 3.8%. That's well above the Fed's 2% target, moving much higher to more uncomfortable levels, particularly for consumers. And we'll get into that on the next slide. But if you look at the charts to the right side of the page, we'll talk about what's going on with inflation and what's going on with jobs. And stable prices, low inflation is one mandate for the Fed, and maximum employment, full job market is the other mandate for the Fed. So right now, these are somewhat in conflict with each other, which is making the environment challenging for this new Fed chairman. But if you look at the charts at the top right, we just have the quarterly annualized percentage change for CPI, so CPI inflation. This is an annualized number based on quarter over quarter changes. And right now we're seeing for headline CPI that move above 7%. That's an eye-opening number. That's not a number anybody wants to see. That's akin back to what we had in 2022, in the summer of 2022, where inflation reached a high of 9%. This is not saying that we are going to reach those levels, but we're on pace for much higher inflation, even with core, which is at 3.28%. So elevated inflation, which makes it hard for the Fed to cut interest rates. But then you look at the job market, and we look at the job market in the chart to the bottom right, where in green we have the non-farm payrolls month over month, so monthly changes in payrolls. So as you can see, we've got this from back into, let's call it 2021 through, early 2026 here. And you can see in the green in the chart, in early 2022 into 24, we had above average job growth month over month, some really strong jobs numbers coming through. And since then, in 2025, we started to see that weaken. And you can see we've had some negative months here, some barely positive months. So cracks in the labor market are the bottom line of what we're seeing here. And then in the bottom part of that chart, in blue, you see total U.S. job openings, where, back in 2022, we had an incredibly large number of job openings in the United States, over 12 million. That has precipitously fallen, and we are now down to 6.8 million job openings in the United States. So we now are at a position where we have more unemployed people in the United States than we do have jobs open. That dynamic has shifted. So there are more job seekers than there are jobs available. So tough environment for the Fed. So typically, if you wanted to boost the labor market, what the Fed would do is lower interest rates, try to spur the economy, spur growth. But if they lower interest rates, they run the risk of overheating the economy as well, which could potentially push interest rates and inflation higher. Push inflation higher, push aggregate prices higher if they are too loose with policy and lower rates too aggressively or at all. And we're also seeing compounding the issues for the Fed is we're starting to see issues with longer-term U.S. Treasury rates, which are largely market-driven. So the 30-year Treasury in recent weeks has risen from about 4.6% to over 5.14%. That's a pretty sharp move for the long end of the curve. And that, to me, that's indicating that investors are demanding greater compensation for what they deem is going to be higher inflation risk over the long run. There's other factors in there that can move that higher, but I think there's a pretty close correlation there between inflation expectations and a higher long-term interest rate there. So lots of things we could get into with rising long-term interest rates, but I'll move on. Just touching on Warsh's history. So early on in his career, call it in the mid-2000s, I want to say 2006 to 2011, Warsh was known as a bit of an inflation hawk in investor language, meaning that he would really favor higher interest rates in order to squelch inflation. He was against quantitative easing. So he was in favor of being very aggressive against inflation and seeing aggregate prices rise. However, he's changed his tune a little bit in recent years, and he's been showing a willingness to lower interest rates a bit more aggressively. And clearly, this caught the eye of President Trump. President Donald Trump has been advocating for lower interest rates for quite some time. I think we've all seen that in the financial news media. I think Warsh is in a tough position, and why he sees inflation potentially moving lower and the justification for lower rates is because of AI and the potential productivity gains due to AI and the advent of AI. And we're seeing, obviously, talk and the spread of AI technology throughout the economy these days. But in short, he believes that AI can produce more goods and services with the same output. So in a sense, that will increase supply, and if demand remains the same, that can bring prices down. So that remains to be seen. Clearly, that's making some clear assumptions there. So I think he could be potentially skeptical of that, but that's part of his philosophy on why lower rates may be warranted. So what does this mean? What's the bottom line from our view? I think it would be really irresponsible for the Fed to lower interest rates anytime soon. Inflation is getting a little out of check here, and if inflation continues to move higher, that can be very, very painful for the U.S. economy, for U.S. consumers. Could potentially change consumer behavior, which would affect consumption, and consumption is what represents over 2/3 of U.S. GDP. So that's really important to track. So despite what you might be seeing in the news media, I've seen articles stating, what does this appointment of Kevin Warsh mean for mortgage rates, for student loans, for the stock market, for bond markets? I think we're going to see a bit of the status quo for the foreseeable future when it comes to interest rates. I don't think the Fed is in any position to change monetary policy right now. And if anything, between now and year end, I could see interest rates potentially moving higher rather than lower, unless we have a significant change with the trajectory of inflation, particularly the war in Iran, closure of the Strait of Hormuz, energy prices, and all that stuff that we've talked about in recent months. So I know that I touched on a lot there. Jarrod, any perspective you would add to that, or anything else I was missing?
Yeah, I mean, inflation, as we've been talking about here for the last 6 years, is the big job that the Fed has. And so, of course, employment is really important. We want a robust economy where, workers who want to work can find jobs and be productive and spend money and do all those things. But when we see core CPI, Consumer Price Index, measure of inflation, at almost 3.3%, that excludes food and energy. So that excludes a lot of these sort of shockwaves that are coming out of the closure over in, with the conflict in Iran. So we have some real inflation issues kind of looking us in the face. And I think as an investment committee, that's definitely our position, is exactly what you said, Tim, that we think interest rates are likely going to stay where they are, if not potentially move a little bit higher this year. So as we think about what that means, higher inflation for consumers and consumer sentiment, I think that's a great segue into the data that we're seeing here. So, I'll let you walk us through everything that's on the screen here, but inflation is going to have a lot of impact on how consumers, especially consumers who are more sensitive to inflation, which is like the bottom 50, 60, 70% on the income spectrum of the economy, are much more sensitive to that inflation number. So, Tim, do you kind of want to walk us through where consumers are at and what we're seeing as a result of that?
Yeah. In recent months, we've seen the largest divergence between consumer sentiment, namely consumer pessimism, and market performance. And you can attach to that investor optimism, right? Investors aren't going to move markets higher unless they are optimistic. So it's been really interesting to see that, and you can see it in the chart to the bottom left there. In red, we have the index of consumer sentiment. That's a monthly survey done by the University of Michigan. basically asking respondents what their assessment of the U.S. economy is at a very general level. And in red, so we have consumer sentiment falling to the lowest of all time at 48.2. That's a staggeringly low number. Meanwhile, in green, we have the S&P 500 index showing markets continuously moving higher. And over the last few weeks, we've seen markets reach new highs. We've seen some volatility in recent days, but nonetheless, markets have, pushed higher regardless of consumer pessimism. And it's just been fascinating to see that dynamic play out. And I think if 2022, and I've spoken about this previously, if 2022 and the inflationary period therein taught me anything, it's how painful inflation is on the consumer. As soon as inflation hits, we see consumer sentiment fall off a cliff. And we've seen that in recent months as the closure of the Strait of Hormuz and energy prices have moved higher. And I think there's a little bit, we talked about this offline, Jarrod, just the perspectives of where you sit and who you are within the global economy or in the U.S. economy can shade how you view this as well. And the charts that we have to the right kind of speak to this. So, these higher prices, higher energy prices, gasoline prices tend to hit, the lower income end of the spectrum much harder than those in the top 20% of the pre-tax income spectrum. So you look at the chart to the top right, and it helps to show this. So it shows pre-tax income for broken down by income cohort, along with, and that's in gray, along with spending, and that's in blue. So if you look at to the far right of this chart, you see the top 20% income generators, and they account for 51% of pre-tax income, and also 38% of spending. But as you can see, their income far outweighs their spending. So there's a gap there. There's a buffer. If prices move higher, they can potentially weather that storm much easier than if you move down to the 60 to 80%, the 40 to 60%, the 20 to 40%, where pre-tax income is lower than spending. So rising prices just compound that issue for those particular folks in those income cohorts. So it's much more painful when gas prices rise from $3.95 to $4.50 when it jumps from $35 to fill up your car to $55 to $60.
Yep.
That's why that seems so much more painful, and that's why we see, in addition to food prices and everything else moving higher, that's why we see consumer sentiment and aggregate falling much lower. It just amplifying how painful that can really be. And then we look at the chart. Please. Yep.
Sorry.
Absolutely. No.
So just thinking about the math there, right? So if the top 20% generates 51% of the pre-tax income and they only spend 38, when we talk about that difference there of the 13%, where does that go? It goes into two places. One is taxes. So the top 20% pay the vast majority of all income taxes paid in the US. So that takes a chunk out. But the remainder of that goes into saving and investment. Right? They're not spending it. It's not going to tax. It has to go to saving and investment. Whereas the bottom 20% is upside down by 6%. They only generate 3% of the pre-tax income, but they spend 9%. Well, how do they make that up? Well, that's income transfer programs, right? So that's where you get your Medicaid funding, Social Security, what is it? SNAP, supplemental,
right.
Like food stamps, essentially. All those other programs are sort of how you get that bottom group back into balance. But if they're short anywhere, if we see inflation come up and their spending has to go to 10%, that's where you see debt, right? Consumer debt that takes off. That's payday lending, that's credit card utilization, things like that. So it's just thinking about that chart intuitively. It's like, well, how do we get into balance there? Taxes, saving, investment, and debt utilization all come into play. Sorry, Tim.
No, yeah, those are really great points. Yeah, thanks for pointing that out, Jarrod. And just the last slide last chart we wanted to cover on this slide was, the net worth growth. So what we're seeing here on the chart to the bottom right is, again, growth by cohort, by income cohort, where net worth growth by income cohort, where in blue we have the top 20%, and in gray we have the bottom 80%. So since 2019, you see that the net worth of the top 20% cohort has grown by $49 trillion. That's quite a boost in net worth there. Whereas the bottom 80%, we've seen a $17 trillion increase. That's nothing to sneeze at, clearly, but they're not seeing the upside that in net worth that we've seen for the top 20%. And that adds to the pessimism. I think that adds to the mindset of the haves and the have-nots in the economy and things like that. Jarrod and I talked a bit about that offline. And adds to that general pessimism that you see kind of permeating the financial news media, political conversations, and all of that. And I think one of the things to think about and what's important to recognize is that, consumer pessimism doesn't necessarily equate to, or just even investor pessimism doesn't necessarily equate to market performance or poor market performance. So we've seen markets continuously move higher, push through any pessimism over the past 3 to 5 years, throughout the COVID pandemic, throughout the inflationary period in 2022, markets continuously pushed higher. So that's why you don't let your emotional decisions drive investments and investment decisions. So I think it's important to stress that as well.
Yeah. And I think that's a perfect segue, as it's almost like we planned this. Who knew? But thinking about, most of us who are on this call right now are watching it, right? We're in that top 20% of households by income and assets, right? So the environment that we're in right now feels very differently to the investor generally. And then you see the consumer sentiment, which is an average, and consumers are really not feeling great. But remember, the vast majority of that spending is coming from those, that top 20%, that top 40% in the economy are doing most of the spending. So how is that translating to what it looks like from, a U.S. equities perspective, kind of a global investing perspective? What are we seeing for performance of companies and investment returns?
Yeah, it's, coming into this quarter, we had, solid expectations for what earnings would do. I think coming into this quarter, we thought, year over year earnings growth might be in the low double digits, so 10 to 13%, something like that. Revenue growth would be okay. And this quarter, we're about 90% of the way through the S&P 500 reporting. And to use an official term, earnings have been absolutely bonkers. I mean, they've really corporations have knocked it out of the park across the board, really, when you're looking at top line revenues. So top line revenue growth has been very strong at 11.4% year over year. That's the highest level since Q2 of 2022. You could see this illustrated in the chart to the top right. I've highlighted that in red, where we've seen consistent growth in revenues quarter over quarter, but 11.4% was what we expected coming into this earnings season. And that's really, top line revenues have really knocked it out of the park. But even more so, seeing year over year earnings growth, earnings per share growth, came in at a whopping 27.7%. As I said, heading into this quarter, investors were expecting somewhere in low double digits, 10 to 13% year over year earnings growth. To be at a close to 28% number is just really, really staggering. It's something that's welcome. I mean, as all investors, as we're trying to gauge what to pay attention to when it comes to the global economy, when it comes to the stock market, these are the things that really, really matter. Earnings growth, revenues. These are what we call the fundamentals. This is what we want to see. And to see this level of earning growth has really fueled the optimism that we've seen to push markets higher and higher, despite what's going on in Iran, despite the closure of the Strait of Hormuz, despite the inflationary pressures and cracks in the labor market. U.S. corporations are doing their part to support the global economy and to support investors. And that's been really, really encouraging. And that's what's driving a lot of the investor optimism that we talked about on the previous slide and touching on here. The Mag 7 is still really relevant in this. Companies like NVIDIA, Micron, Alphabet, Meta, Amazon, they're making outsized contributions, not only to revenues, but earnings growth. And we're also seeing historically high net profit margins. So the blended net profit margin for the S&P 500 right now is almost 15%. That is a record high since FactSet began tracking this data back in 2009. So, like I said, across the board, top line, bottom line, net profits, the U.S. corporations, the U.S. stock market, the S&P 500 is really knocking it out of the park. And we've seen that in major index returns. We've seen a boost happen since the onset of the war in Iran in late March. Since then, we've seen markets move much higher, and we have the S&P 500 currently close to 8% year-over-year or year to date. Excuse me. The Dow's have been a little bit lower at 3.3%. Nasdaq 11.5%. The Russell 2000 11.1%. What this is telling me, at least for the stock market, is that investors are favoring growth companies a little bit more. A few months ago, value companies were in vogue a little bit more, but the growth has really taken off. The growth companies have really taken off and boosted the Nasdaq, namely, and even the S&P 500, as those big companies, the mega caps, Mag 7 companies, have produced really strong earnings. We do have the bond market, however, that's moved negative on a year-to-date basis. That's largely due to what we've seen in the longer end of the curve for U.S. Treasuries, where we've seen 10 and 30-year Treasury rates move higher, as I talked about on the first slide of this presentation. So that's difficult as interest rates move higher, bond prices move lower. There's an inverse relationship there, and that's what we've seen. It's not been a huge hit to the bond market, nothing like we saw in previous years where we saw the bond market in 2022 down 18%. This is nothing like that, but we've seen bonds, the aggregate bond index in the U.S. move to negative 1%, which is not killing portfolios, but not what we were looking for from our fixed income positions. But nonetheless, stocks are carrying the day, and bond markets are hanging in there despite some pressure from the interest rate environment and rising interest rates. So that's kind of the big picture of where we see things right now, what markets are doing, and what U.S. corporations have done this quarter, which is, like I said, very encouraging.
Mm-hmm. Yeah, absolutely. And I always like to look at, what does revenue growth and earnings growth look like comparatively? So across the broad market, right, we're seeing earning or revenue growth up 11%, earnings growth up 28, which means companies are getting more effective at generating profits from each incremental new dollar of revenue across the board. It's not every company, it's not every quarter, but broadly, that's a really interesting trend. And I think, as we talk about the impact of AI and just, non-AI technology, quite frankly, that we continue to get better at getting more productivity out of the same dollar of revenue. It's really incredible to watch that continue to play out quarter after quarter.
Yep, absolutely.
Awesome. Well, I think, as we kind of wrap up our talk today, Tim, what would be your number one takeaway that we'd like to leave our audience with from our conversation today?
Yeah, I think it's just, speaking back to that second slide that we covered, it's the behavioral relationship and between behavior and finance, pessimism and investing. You do not want to let your emotions guide investing decisions throughout your investing life. That's one of our tenets here at Destiny Capital. Decisions made using gut feelings or emotion tend to lead to negative outcomes, and we've seen that play out with investors who try to time the market or think something negative is on the horizon. They exit the markets or trim down a position only to see markets continue to move higher. So that's a lesson that we can all take from this. And just despite what you may be feeling, it's always important to focus on the fundamentals, what we talked about in that last slide, see what's really going on underneath the hood of the U.S. corporations that we invest in. And recently that's been nothing but encouraging and positive. So I think that's a good note to leave it on.
Yeah, I think I pulled this back up just to echo your point, Tim, as we look at, I know it's hard to see in the lower right-hand corner, but the purple line is the NASDAQ, so the tech-heavy index. And if we just look at, April 1st, that index is down about 10% year to date. And then we fast forward about 45 days, and there's a 25% move up in that index, which is not like a small amount of money. That's not a small set of companies there. And just how rapidly markets can change. And that, it really is important to just try and be as non-emotional as possible, be disciplined in the approach, have good forecasts around your cash and cash flow needs so that
Yeah.
you can kind of weather some of these bumpy periods, which we are likely to see going forward. If we have resurgent inflation, if we have issues in the labor market, markets are going to move, and that's what they tend to do. But looking at the long-term investment performance is the way that we should keep our focus. So,
Yep.
well, I think one last plug, if you could go to destinycapital.com, submit questions for Tim and I for future episodes. We want to make sure that this is really a good value add. So we always look forward to feedback, recommendations for things you want us to talk about, and we really appreciate your time and you being a part of this process. So thanks everybody for giving us some of your valuable time, and we'll be back with you again here in June.
Thanks, everyone. Talk to you soon.